correction today that we saw. Let's get right to it. Mark Tepper, Strategist Wealth Partners president, is calling for a market correction. I hope you just heard Mark Faber as well. He, of course, is constantly calling for a correction, but still bullish on stocks. David Traynor, new Construct CEO, his last stock pick when he was here, up more than 16% since he told you to buy it. He's back with more money plays. And Larry Shover in the pits of the CME. Larry, you get first crack at a day like this. Wow.
Well, a day like this, we had strong bond yields with the sovereign bonds. We had good earnings, some good enough earnings, offset by global PMIs. That's confirming the fact that we're in a cool down camp as a world. However, the stock market looked right beyond that. Look at the earnings. Look at the sovereign bond yields falling. I mean, good grief. We have Spain at 4.25% right now. This is a good thing for Europe. So we're seeing the rally that we're seeing behind us. It's disbelief. It's frustration. People are throwing in the towel as we speak.
By the way, that dip again, we want to emphasize that you see in the hour-by-hour tick. That was because of that bad report. AP's account was hacked into, and a bad Twitter was sent out about a terror attack, which was not true. So that's why you see that red mark down there. Mark, let me go to you. There was a dip in the market last week. We saw a dip of over 2% in all of the various indexes. Was that the pullback that we have been hearing about, or is there more to come?
No, there's going to be, I would say, at least a 7-8% pullback in the summer months. So the market's come a very long way in a short period of time. We've got a year-end target on the S&P at about 1,600. So, we're expecting some soft economic data in May, in June. Really, that's when the sequester is going to be felt in the economic data. We are concerned that there's going to be a bit of a consumer pinch. So we would expect that pullback to come in the summer months. Hold on a second.
Even though every time we have seen these bad economic numbers, we've seen a very quick comeback by the stock market.
Yeah, and I don't doubt that we will see a quick comeback. I mean, we're looking at, I could see the market dropping, the S&P dropping below 1,500, but still coming back to finish off the year at 1,600, which would be an exceptional year in the S&P 500. That'd be a great year. When you look back at 2012, almost all the gains in the S&P 500 came from multiple expansion, not from earnings growth. And we don't anticipate a stellar earnings year in 2013 either. So in order for the S&P to continue to advance, we have to see more multiple expansion. And with international growth looking fairly weak, and with us really not seeing, we are expecting some softening in the U.S. economic data in the summer months, it's going to be very, very tough to break through 1,600.
Okay, we heard many people, smart like you, say the exact same thing about last quarter. And what do we see? We see a market that continues to move higher, David, because the Fed is right there. You can either fight the tape or you can go with the flow. Which one are you doing?
Well, I'm not necessarily going with the flow. I think that the long-term outlook is that we're going through sort of a restructuring in our economy and in our workforce. If we were to go back to boom times with respect to growth, both in GDP and the employment, that'd be people getting back into the same jobs that were ruined or lost in the bubble. And I think it's good that that's not happening. I think we're seeing more diligent capital allocation, people learning new skills, retraining themselves to be better equipped to be productive in a digital economy. And I think that means some slowness here in the near term, but long term, I believe the country is going to be stronger than ever. And I think when it comes for investing, investors have to be diligent. It's not going to be an easy call when the market's going straight up or easy call when it's going straight down. You got to do your homework.
Larry Shover, the phrase of the day is capital allocation. We're all expecting Apple to do something with that $137 billion, whether it's pay out a bigger dividend over 3% or do stock buybacks or some of that. Isn't there an end game here where that hasn't really been looked at by a lot of investors that jump on the news of an increased dividend? That is to say, if you're not investing in the future of the company rather than just paying out shareholders, perhaps you're making a mistake.
Yeah, and I think that's just the point. I think people are looking around and hoping for some type of capital return, whatever it happens to be. I've heard expectations all over the map, just like you mentioned. But I think we need to look beyond that and say, look, let's look at the future. Is it going to be Apple TV? Is it going to be a deal with China Mobile? Is it going to be a lowering of the price of the iPhone? All these things. They need something big to go forward. I do like this stock long term and even short term if you're hedged. But yes, it's the capital return is nothing but a Band-Aid. They need something big to move the stock forward.
Okay, let's have our guests show us the money. Mark, I want to hear your picks at the moment because one of them is an obvious one. I mean, it's Apple, and we're waiting on this right now. But are you of the belief that they're going to, as we have seen in the past, underpromise and then overdeliver in just a few minutes when these numbers come out?
Yeah, I do. I do think they are going to beat the current estimates. I think the whisper number right now is like over 1050. I do think they're going to overdeliver. Really, Apple's a great company. I mean, they've got $150 billion of cash on the balance sheet. They're not going out of business tomorrow. They're very undervalued right now. When you strip out the cash, you're looking at a 5.7 PE ratio right now, which is, I mean, the company's trading at a significant discount to has-beens like, Dell, Microsoft. And I don't think it's really fair that Apple's valued at such a low discount to those companies.
But David, on the other hand, some people are saying that Apple is a has-been. You don't like Apple right now. Why not?
Well, I don't think it's fair to say that Apple's trading at a discount to Dell and these other companies. When I look at the valuation, at the economics of the business, the price implies something like a 60 or 70% return on invested capital. They're at 130 right now. And I think 60 or 70% is a pretty good return on capital for a company in the consumer electronics business. And so I think, look, unless Apple's able to come up with the next great big thing, there's no way they're going to be able to maintain the pricing power that's enabled them to have the high margins and the premium valuation that they've been enjoying.
Okay, that's the thing, Larry. I mean, if you're looking at numbers and earnings and all kinds of reports, the reality is, though, that this market continues to defy gravity, even with all kinds of bad news. What do you think derails it, if anything?
Well, it's going to come down to growth. I mean, let's face it, people are getting excited about sovereign yields getting so low, but the problems in Europe have not gone away. We can thank goodness for OMT. That has helped a lot, but the problems haven't gone away. Also, we have a federal balance sheet, $3.2 trillion. Nobody knows how to unwind that. Nobody knows how to manage that, so something's going to have to give. Lastly, right now, we're running at a 2% GDP. That is not growth. We're moving along, we're stumbling along, but something of those three is going to derail this market. This is my target for the end of the year, what we're seeing right now. I don't see any higher for the rest of the year.
By the way, another pick by Mark is Vodafone. I wanted to get that in because we're talking a lot about other subjects and specifically Apple. There are some other stocks that are doing quite well. Guys, thank you very much.
Thank you.
Mark Tepper, David Traynor, and Larry Shover.